Jab. Stream. What's going on? What's happening? What's happening? What's happening? Let's get to it. Let's get to it. Let's hustle. Let's hustle. Let's go. Today, we're going to be talking about the Consumer Price Index, also known as the CPI. I want to jump into why it's critical for investors, and let's understand what this report even is. So let's understand the Consumer Price Index, also known as the CPI. It's going to be extremely simple, and I want to break it down, and I want you guys to understand. Let's go. So what is the CPI in the first place? So the CPI, think of it as a basket of goods. So imagine a giant shopping cart that represents what the average American buys. This is going to go ahead and represent gas prices, groceries prices, food prices, the price of the current rent, housing, etc. Okay, all of this is going to be compiled into a big list, and the government tracks everything. And depending on how much this stuff costs, is going to give us a certain result based on the CPI report. So the Bureau of Labor Statistics, also known as the BLS, tracks the price of the specific basket every single month to measure inflation. Okay, so they measure housing, food and beverages, car prices, okay, and things related to cars as well too. Cars themselves, gas prices, and even ticket prices for planes and stuff, etc. Okay, and as well as the medical care prices, prices of certain pills, prices of certain procedures, etc. All of that gets tracked by the Bureau of Labor Statistics and gets put into a big report, and that lets us know how well the economy is doing. Okay, so let's continue on, and breaking it down and understanding this is really going to help us know, okay, is the market in a desperate period right now? Are people saving right now? Are people selling their houses right now? Okay, and you really got to ask yourself a couple of questions and put things into perspective. Okay, so let's continue on and let's understand what the CPI is. So let's talk about measuring the inflation. Okay, measuring inflation. So the year-over-year review, YOY. Okay, when you hear inflation is 5%, it means that the basket of goods cost 5% more today than it did 12 months ago. So that means that the price of a hot dog, let's say in 2015, let's say the price of a hot dog was $2. If in 2025, the price of the hot dog is now $6, okay, inflation occurred. The price went up. The price of the hot dog got more expensive year after year after year. So within a 10-year span, hot dogs went from $2 to $6. So that means that it got $4 more expensive just because time occurred. So that's what inflation is, when stuff is getting more expensive over time. And the reason why that's occurring is because more dollars are getting printed. The more dollars that get printed, then the more prices have to equate for that. Prices are going to equate with how many dollars are available. If there's a lot more dollars getting printed year after year after year after year, then logically things have to result and coincide with that and get more expensive. So why investors even care in the first place? So if inflation is 5% and your portfolio grew 4%, then you actually lost purchasing power. Okay. And the core versus the headline. So stripping the noise. So there's going to be two main types of CPI numbers that are going to go ahead and be released. So there's going to be the headline CPI. The headline CPI is everything in the basket. Once again, we're calculating the food, rent, gas prices, okay, price of certain waters, whether that be for water in our houses, for shower, toilets, etc., or the price of bottled water, okay, price of ice cream. All of that is going to be calculated inside of the basket. And the actual raw number is going to let us know how much Americans are spending on consumerism. That's why it's called the CPI, Consumer Price Index, letting us know how much the economy has consumed. And the core CPI, okay, it removes the food and energy prices from the equation. So the core CPI removes food and energy prices because food and gas prices are going to be volatile. They change every single week, okay? And they change a lot quicker than other things as well too. Okay, food can be thrown on sale. One day a box of macaroni could be $5. Okay, you come back to the store next week, and it's back again at $15. Same thing with gas. You could go to one gas station, they might be charging you $3 a gallon for some 87, and then at another gas station for some 87, it might cost you 2.79. Okay, so it's really going to go ahead and differentiate, and food and energy are going to be a lot more volatile than other things related into the basket. So the Fed prefers just the core CPI, and the core CPI is the number calculated in the basket of the stuff that Americans are consuming, okay? And other countries have CPI too, but in this case, we'll just talk about US, but it takes the amount of resources that a country is consuming, and the core CPI report is just going to go ahead and remove food and gas prices since they're volatile and could hedge the numbers and make them spike up higher than they maybe should be. So the federal connection. So we'll talk about the policy tool. The Federal Reserve has a mandate to keep inflation at around 2%. 2% is going to be a pretty stable rate, and that's letting us know that the economy is not going in haywire. So a high CPI, the Fed will raise interest rates to cool the economy down, okay, which is going to be really bad for stocks and bonds. If people are paying more money and percentage yields on interest, then that's going to go ahead and leave them less money to invest. Or what people would go ahead and do is take out their investments in order to make up for certain interest rates getting more expensive, etc. And we'll talk about a low CPI rate. So when the economy is in a good position, it's very stable, and it's in a cool position, the Fed may lower the interest rates to stimulate the growth because people are going to be paying back less in loans, paying back less in debt, etc., leaving a lot more supplemental income to invest into stocks. So when the CPI report is low, a lot of the times you start seeing market burst up in an upwards direction because it's letting us know that everyone else has money, and the stock market and crypto market, we move as whales and sheeps. Everyone has to be doing the same thing in order for the market to move. Everyone has to be buying at once in order for it to go up, and everyone has to be selling in order for it to go down. So that's why it's really imperative to make sure you're trading with the trend. If you're not trading with the trend, you're just going to be losing money for no reason. And that's why Wall Street really holds its breath on CPI release date. It's really a big report that predicts what the Fed will do next and a big predictor on how the market will move. A lot of the times right after the CPI report drops, especially if you're a futures or forex trader, you can get on your 1 minute and you could see the actual candle of CPI. So seeing that and watching those month after month after month of CPIs really taught me and let me know how the market decides to trend after CPI report hits the market. And market volatility, so the tantrum that it throws. So algorithms read the CPI report in milliseconds, and the market reaction can be extremely violent. In a second, CPI could make the market zip down or burst in an upwards direction. And once again, if you're on your futures 1 minute, you can see it and see the news directly. And CPI coming in hot is going to mean that stocks have a higher chance to drop in a downwards direction due to the fact that interest rates are going to be higher. So interest is going to be bad. There's a reason why God talks about it in a negative manner. Interest does not benefit anything. Interest only hurts. It hurts the people, hurts the stock market, and it just leaves us less money in order for actually building our actual assets, whether it be it for real estate, building your stock portfolio, etc. And if the CPI report comes in cool and lower, a lot of the time stock has a good chance to rally in an upwards direction. Same thing with the indexes, known as the NQ, which is going to represent for the NASDAQ 100. You're going to have the ES, which is going to represent the S&P 500. You're going to have the Dow Jones, which is going to represent the YM, also known as US 30. Okay, so each one of these things are going to be affected by the CPI. So CPI is an extremely, extremely, extremely important report. And what you might see actually a lot of the times is price action slowing down, getting a little choppy, getting a little slow before the CPI report comes out. Because people are holding their tongues, they're freezing their wallet. They're like, hold on, before I deploy this bread, let me make sure market's doing what it actually needs to be doing. And then boom, they're going to go ahead and put that money down. So watch the trend. One bad month is not a crisis, but a trend is. Watch how the trend shifts after CPI. Does market want to head in an upwards direction? Does market want to go in a negative direction? Okay, and for how long? Make sure you're trading with the trend. Trading with the trend is going to be the separation tool between being profitable and unprofitable. Okay, you have to make the decision that the market is making. Otherwise, you will lose money. If market's going in an upwards direction, that is the direction that you should be playing in. And it's not at all-time highs, then that's how you should be playing. Okay. If you're on a Forex trade for something like that, for example, and a CPI report comes out and a currency pair starts going downwards, okay, then that's going to go ahead and let you know the trend. I don't care if you're on stocks, Forex, futures, wherever. Be wary of the CPI report, especially before you put in the trade. Okay. Keeping an eye on news, and a lot of the times you'll notice too, news is going to be baked into the price action too. So try not to fight the Fed. If CPI is high and rates stay high, try to adjust your portfolio. Okay. Stay prayed up to God. Keep grinding. If you want to learn more about investing, head over to stackmode.net. I'm here for you guys for any type of situation, whether you guys are struggling with unprofitability, whether you're profitable right now, but you just want to be a little more consistent. You want to see how you can funnel more of your income. Just come book a free call. I'm here for you guys. I'm going to catch you guys in the next one. Peace.